Anand Tandon joins in now, CEO of JRG Securities, to talk about how he's read the start of 2011. Anand, morning. Thanks for joining in. Do you see more downside, or do you think we're done for the moment?
I think near term the market looks a little oversold. We've had a very sharp pullback, but you may get therefore a small bounce from here. Overall, I think as we've discussed before, the headwinds continue to build up, and now we can add another one to the kitty of the economic woes that we had earlier, which is that it looks like the politics is becoming definitely a lot more charged up than it was, let's say, a few months ago, and that brings into for some fears that this may spill over to the budget session with fairly disastrous effects.
Anand, morning. Would you go so far as to say, though, that this may be the range the market lives in the better part of this year, rather than above the 6,000 mark?
I think you'll find that the first quarter is somewhat on the down, and then perhaps that should give us some reason for it to go back up again. So if you look at the earnings estimate as of today, which shows almost a 22% kind of growth from the year, on that basis alone, I would argue that there would be a 15 to 17% upside year on year over the period of the first 12 months. But given that the near-term outlook is bleak, it could be that you may find a significant drop in the first half, which will then give you a chance to actually make some serious money. On a point-to-point basis, the market, I think, will remain somewhat in the 6,000 odd range. Difficult to hazard a guess whether it is 200 points up or down, but broadly in that range is what I would expect for the end of the year.
Which of the rate sensitives might still fall from here, though, Anand?
Actually, all of them. I heard Nirmal mentioned a while back that banking is something that can become weaker this year, and I quite agree with him. I think that's also one of the most over-owned sectors, something which most people have stacked up on in a very big way. I think some of the construction companies, especially those with large bought projects, can actually again find some problems in terms of financing as well as in terms of their NAV calculations. So I think interest rate sensitives, by and large, we've seen very interesting things. Like, for example, take auto loans. It appears that auto loans are now better than any kind of prime lending, because you can get an auto loan at a price which is lower than the deposit rate of most banks. Now, given that the demand has been very robust, I doubt very much that the companies are increasing the subvention levels, which essentially means that the banks are taking a hit on the loan pricing. One wonders why, because clearly that would indicate that there is not enough quality loan possibility from outside some of these kind of areas. Which means that while we are seeing a 22% growth in credit, it is not necessarily to areas which is making a lot of money, or where banks feel very safe lending out. Similarly, you'll find that this kind of dichotomy will continue to remain, that you may have priority sector lending, for example, slowing down significantly, and therefore the banks may be forced to go out and lend to sectors which otherwise they would not have, on the back of issues that we've seen in microfinance, for example. So some of those things will cause some distortions in the market, and I think that will persist for pretty much the whole of this year.
Pre-opening session is done flat, actually 5 points up only on the Nifty. That's at 5767. The Sensex up 50 points. So after losing 1,000 points in 2 days, 50 points does not herald a major pullback rally or anything like that. So let's see how the initial session pans out, but we'll get the actual rates in about 5 minutes time. Anand, you were talking about politics as a negative trigger. What is your expectation of how things might pan out on that front, starting with the budget session in Feb?
Well, again, the thing that gets me worried is that it appears that both the major parties have kind of ratcheted up the noise level quite a bit. On the one hand, the BJP and the NDA actually has been making a big issue of corruption, as it should be, rightly so. But simultaneously, we find that the ruling party, the ruling coalition, has actually begun to take the war, as it were, to the opposition court by accusing them of terrorism. Now, that doesn't leave too much place to maneuver for either party, even if they want to back off from this kind of confrontation. So, the question is what will allow the next parliament session to go on. And given that the JPC demand cannot be now withdrawn from the looks of it because of loss of face, and the ruling coalition is not willing to let go, you may actually see a continuation of the kind of imbroglio that we had in the last session of Parliament. Now, if you get into that kind of situation, what will happen to the finance bill is a moot point. So I think that is probably one of the things that will bother any investor, especially if you're looking at it from overseas, where once the macro doesn't look that attractive, and the major country in the world, especially the US, has started to show some signs of recovery. Why would you go into an overstretched market with rising interest rates and then with some political uncertainty to boot?
Do you then see the trend of the last few weeks accelerating, Anand, where a large number of global investors who were overweight India trying to scale down their overweight positions?
I think on a relative basis, yes. I've argued about this before that on a relative emerging market bias, we've already seen India do much better in terms of fund flows. And for the most of last year, emerging markets did better as an asset class compared to the developed markets. Now that there is some reason for the developed market themselves to do slightly better, first, the flows to emerging markets may actually slow down, and then secondly, to India for sure within that space may become slightly more back to trend. On either case, we will see. So I'm not arguing that you'll get an outflow necessarily for the whole year, but I'm saying that you may get back to a normal, quote-unquote, normal kind of investment trend, which means give or take around between 18 and 22 billion dollars. That I don't think is enough to take the market up from the current environment, especially because many of the macro factors globally, especially in Europe, are going to become big problem areas this year.
Would you also prime yourself for an earnings downgrade for this market, Anand, given what's happening with commodities?
So I think last year we saw that most of the earnings growth was supposed to come from oil and gas, banking and commodities. This year I think oil and gas is in the hands of the government, and given the current inflationary situation, I don't think they have too much room to play on the upside. So if oil prices continue to go up, I think you'll find some pressure there. For sure, banking, I'm reasonably certain, will not perform anywhere close to what it did last year, which essentially puts the whole onus of showing us the strong earnings growth onto the commodity sector. Unfortunately, the part of the commodity sector which we really like, which is the agri commodities and gold, is not represented in the market. For the rest of it, when you're looking at industrial commodities, those are largely dependent on economic growth in the rest of the world, which, while it will be better than last year, I think is going to be anemic in large parts of it.